Good morning, everybody. It's great to see the big turnout, both in person and remotely. Grant and I have of all the presenters, Grant and I have the best job today, which is talking about Athene. We love talking about Athene. Athene and Apollo have built the premier retirement services company. We put in 15 years of hard work, consistent, excellent execution, and discipline to build the machine. We've grown from a startup to the industry leader by leveraging our competitive advantages. We have an efficient model with a superior asset management strategy. This creates better outcomes for policyholders and shareholders. We're incredibly proud of our franchise and our positioning. Our track record is very hard to replicate. Nobody else in the industry can show a chart like this. We always think and act like owners, and this is demonstrated through our consistent, profitable growth over time, with periods of stair-step increases as we lean in and out of attractive opportunities. Recently, organic growth has been the most attractive. There's a deep moat around our business with 5 key competitive advantages bolstered by very strong ratings, which are a significant barrier to entry for others. Our advantages are very difficult to replicate, starting with our ability to generate yield. We have an incredibly efficient and scalable operating platform, product and channel diversification that is expanding, financial flexibility from fortress balance sheet and sidecars with a strong and improving ratings profile. And finally, we have the best management team in the business, and we have an intense drive to compete and to win, and our culture is a meritocracy. We target higher, sustainable, risk-adjusted returns by taking some structure and liquidity risk, not incremental credit risk. Our access to Apollo's proprietary investment-grade origination provides differentiated value-add asset opportunities. No one else has that. Our portfolio construction on the asset side is focused on high-grade, almost all fixed income assets and investment grade. We've consistently produced attractive growth and returns. We have a higher allocation to assets which provide excess return per unit of risk. This results in Athene taking less risk relative to others. We are underallocated to high-yield assets, and we have zero real estate equity, unlike others. We outperform on both asset yields and impairments, which is a very powerful combination. From 2019 to 2023, we generated 40 basis points of asset outperformance with only 11 basis points of credit losses. So scale is one of our competitive advantages, and it's very important to our platform. Athene was built to have high efficiency and productivity. We benefit from not being burdened by legacy business that we don't want. And this final point I'm going to make on this slide is pretty impressive. We have 5 times the earnings per employee than the industry. Each and every person in our company is highly valuable. These competitive advantages drive positive outcomes. For the customer, better pricing, and for the shareholder, better returns. Our number one priority is maintaining a fortress balance sheet. This means we are steadfast in ensuring that there is excess capital and excess liquidity at all times. We have a variety of liquidity sources, from our cash on hand, our liquid public investment-grade portfolio, our committed repo lines, our operating company credit facilities, and our traditional holding company capital facility. On the capital side, look, in the last 12 months, we've created over $3 billion of spread-related earnings, $70 billion of organic inflows, and 17% growth in gross invested assets. These resources provide the flexibility needed to execute on the significant opportunity in the retirement services market. We always run the business as owners, which allows us to consistently achieve very strong returns. And because of those returns, we're able to raise third-party capital to support our growth. Others can't do that. We've successfully raised over $9 billion in third-party assets, including the largest sidecar in the industry. The amount of business we can support with just third-party capital is now greater than the entire asset bases of many firms. Since 2010, Apollo and Athene are the largest contributors of capital to the retirement services industry at about $20 billion. We've raised 40% of all the private capital and 50% of all the public capital in the industry since 2010. Meanwhile, at the same time, the broader industry has returned to investors 80% of their total market cap because they haven't had the same ability to grow profitably because they don't have the returns that investors want. The last I checked, companies can't grow without capital. Our superior financial strength is recognized by the rating agencies. We have a clear upward ratings trend, and we believe we're on a path to AA across the board. Noteworthy is the fact that today, we hold billions of dollars of excess capital above, greater than, the S&P AAA level. Our track record of execution has led to increasing recognition, including an AM Best upgrade to A+, which under their hierarchy puts us into the AA category, and we think there's more of that to come. Athene is the largest retirement services company rated A+, with $33 billion of regulatory capital. For years, we've been running the company to greater than AAA standards. And with that, I'll turn it over to Grant.
Thanks, Jim, and good morning, everyone. We serve a societal need, which is helping people save for retirement and then turning that savings into guaranteed income in retirement. And this business has a substantial tailwind behind it of an aging population that is unprepared for retirement. More than 11,000 Americans reach retirement age every day. And today, you can see on this chart, roughly 58 million Americans aged 65 and older, and by 2050, that becomes 82 million. Our average customer is in their late 50s to mid 60s, and you see that this aging demographic is moving people into the sweet spot where we can help them. This tailwind to our business will exist for several decades. And that aging population is woefully unprepared. 75% of retirees have income below $75,000. Almost half of Americans don't participate in a retirement plan. And 33% of Americans, of pre-retirees, say they are concerned about running out of assets in retirement. We estimate that the savings gap is about $4 trillion in the US. And it's not just a US problem. This is a global challenge, this retirement crisis. And we estimate the total target market globally is 45 trillion. And you think about where Athene sits as the industry leader in retirement services, we're less than 1% of the global opportunity. We are really just scratching the surface of what we think our business can be. So where are we going? You know, we presented at Investor Day in October of 21, shared with you a 5-year plan, and we met our SRE goal at the end of 2023. So we're here today to say again, we think we have a big opportunity in front of us. And we think that we can double the business in the next 5 years, earning 10% on average SRE, but do it in a capital lighter way by utilizing third-party capital and creating capital light and capital lighter products. Mark talked about widening the funnel and opening the aperture. By widening the funnel, we're thinking about continued distribution expansion, new products in our existing channels, and entering adjacent markets. And when we talk about opening the aperture, we're thinking about new products in new markets. And overlaying all of this, we retain an inorganic option when we see attractive opportunities. Mark and Jim have both mentioned that we act like owner-operators. What does that mean? It means that growth is a choice. And we don't have to do anything. And we only do things that meet our unlevered mid-teens return criteria. That said, we've consistently found opportunities to meet that hurdle. And in generating 23 times organic growth in the last decade, we are a market leader in each of the channels that we operate in. Now, nobody in our industry can show you a chart that looks like this, that has delivered consistent, growing, diversified, profitable growth. But even if we chose not to grow, if we flatlined our origination at 70 billion, our AUM and SRE would grow for years and throw off significant amounts of capital. And that capital could be used to retain more of the business that we're originating or used as an increased dividend to Apollo. We've talked for years about our 4 channels, but these channels have really developed 13 sub-channels that are scaled and deliver a much broader array of products. A decade ago, 2014, 2 channels, a small handful of products. Today, 13 scaled sub-channels delivering more than 50 unique products. It gives us tremendous flexibility. A lifetime example. We gave guidance earlier this year that we thought we could originate 70 billion organically this calendar year. That was before any of the PRT lawsuits. We were anticipating that PRT would be 14, if not 15 billion of that 70. It's a fraction of that, a small fraction of that. And yet we are going to meet that 70 billion goal. We're going to deliver on what we said. That's the flexibility of our footprint that none of our competitors have, that allows us to pivot either driven by market opportunity or necessity. When we say that in our plan, we're anticipating entering adjacent and new markets and developing new products, we have a successful track record of doing that. And here's a few examples. We launched pension group, what we call pension group annuities, the rest of the world calls pension risk transfer, in 2017. And in the last 4 years, we've had the #1 market share and grown to 42 billion in reserves. We introduced Ascent Pro into our retail annuities channel in 2016, and it's now grown to over 18 billion in reserves. And this year alone, it's already sold more than 4 billion. And we started our international diversification in Asia back in 2020, and we've already originated 12 billion. We have 8 active flow treaties across Japan and Singapore, covering both annuity and life insurance products. There's many more examples. You cannot get 23 times growth without coming up with new products, entering new markets, and continually expanding your distribution footprint. Retail annuities is our largest channel, and it continues to be our largest opportunity. There's still room to grow in institutional distribution, activating agents within distribution, getting more shelf space at distributors, introducing new products. We have a differentiated footprint that no one can match, with strength across the independent channel, banks, independent broker-dealers, and wirehouses. And what that leads to is the results you see in the top right-hand side of this slide, where we sell more annuities than anyone. We certainly sell the most of the products that we're focused on in fixed and fixed-indexed annuities. We are the largest distributor in banks, and banks is the biggest distribution channel now for annuities, and we maintain strength in the independent channel. The lower right-hand side shows that 5 of our 6 largest distributors we've all added in the last 5 years. We are the largest seller by far on every one of those platforms. When we get an opportunity in a new channel, we shine and we dominate. And on the left-hand side, you see that from a startup in 2011, startup in the retail annuity business, we've grown our market share to 12%. No reason to stop here. Why not 15? Why not 18? Why not more? Our expansion in retail annuities was a strategic plan that we developed in 2011, and we're still executing on that plan. It takes consistent, sustained commitment year after year after year. It takes capital, it takes ratings, it takes investment in technology, it takes new products, it takes scaling your sales force and your marketing along with your opportunities, and of course delivering great service. And then on top of that, there's the moat that Jim and Mark have talked about in terms of our competitive advantages. And it gives 2 outcomes to our business. We can offer great consumer value proposition while still generating superior returns for our shareholders. What we've done is very difficult to replicate, and we're an incredibly tough competitor. We're also playing in the right space in the annuity market. When we set out in 2011 to enter this space, the market was about $225 billion, and we wanted to play in about 1/3 of it. So we said, hey, we're going to have a $70 billion target market, and if we're really good at executing, maybe we can get 7 to 10% market share over a period of years. So we were thinking this was a $5 to $7.5 billion market opportunity for us. We originated more than $35 billion last year. So obviously a few things happened that you can see on this chart. First of all, the space that we chose to compete in, fixed indexed annuities, it's a superior product of variable annuities. And that battle is largely won in the marketplace. And the market, which hadn't been growing for years when we entered it, has gone from being a $225 billion a year market to this year, it will be north of $400 billion. We also entered the RILA space, so now we're competing in 85% of a much larger market versus competing in 1/3 of a much smaller market. Very exciting development. Sometimes it's good to be lucky as well as good. In thinking like owners, we pounce on opportunities. And in addition to what's on the slide here, I think what we did in the retail annuities last year is a great example. The market grew over 30% last year. And we had the capital, we had the products, we had the distribution footprint, and we had the asset yield to be able to jump on that opportunity. We sold more annuities last year than anyone has ever sold in a single calendar year. Inorganically, we look at everything and we transact when it makes sense, and there's very little about the current market that makes sense to us. Deals clear at returns that are well below what's available organically, and for liability types that are highly challenged and often have degraded, very degraded surrender charges. So the market's paying a higher price for riskier liabilities. And that leads the winners to engage in capital arbitrage by reinsuring offshore. I think the only way that you can make sense of what we see currently in the inorganic space is that the people doing these deals don't have scaled organic options. We have a number of growth opportunities that offer upside potential. Internationally, I've already discussed that a bit. We see there's a lot more there available for us. In RILA and Athene Altitude, the tax advantage product that Stephanie mentioned, it's really about expanding distribution because our products are pretty great. In structured settlements and stable value, it's about entering adjacent markets and being a disruptor, as we think we can be. Defined contribution, you've heard a number of people mention that. It's a 15 trillion market. It's early days for people trying to crack the code of how to deliver both alternatives and guaranteed income into that space. But we want to participate both as a manufacturer and a parts supplier. We're still working on ideas on how to create incremental and possibly standalone guaranteed income solutions. There's certainly strong interest in both the RIA channel, and we think it could be part of the solution in the DC space as well. All of these things have relatively modest numbers in our 5-year plan. So success here would be significant upside. Regardless, many of these have long lead times, and they will be significant contributors to Athene in the future, even if it's beyond the scope of the 5-year plan. Just want to share a little bit about what we see as a potential future state for target date fund. We think Athene and Apollo are pretty uniquely positioned, working together with a target date fund manager to create a future state TDF. Adding alts will drive greater accumulation. Adding guaranteed income assumes you won't outlive your assets. We think the combination could produce 60% or more retirement income compared to a traditional target date fund with a 4% annual withdrawal rate. Zero chance that the retiree will outlive their assets. And these products, as we're constructing them, will provide the flexibility and the liquidity that you need in a target date fund. And with that, I'll turn it back to Jim.
Look, our future growth will be guided by the same winning approach we've historically used. As Grant said, SRE growth is a choice. As owners of the business, we know there will be steps as we move in and out of attractive cycles. We manage Athene's business for the long term, targeting consistent mid-teens returns over time. When we consider how this capital management philosophy manifests throughout the business, 3 concepts are at work. 1, holding excess capital and liquidity allows us to capture wide spreads and maintain a fortress balance sheet. 2, active portfolio management. We strategically reduced our net floating rate asset exposure by 50% and reallocated to treasuries ahead of rate declines, which provides built-in gains to redeploy, as 2 examples. And 3, we are very disciplined operators. We went 6 quarters recently without issuing public funding agreements when targeted returns weren't sufficient. We've also de-emphasized MYGA sales when pricing became irrational. Athene does not seek to maximize profits or ROE in the short term. We've always operated this way and will continue to do so. Look, in summary, Grant told me this morning that, and I didn't know this, there are now 28 private equity backed, so to speak, insurance companies trying to copy us. Based on what you've heard this morning in our presentation, we expect to widen our lead, not shrink it, against all the other copycats, because no one can replicate our business model. The combination of state-of-the-art, value-add asset origination, coupled with the biggest and best manufacturer and distributor of retirement savings products, nobody else has that. So you can see the takeaways. We're the leader, we're disciplined operators, and we have a substantial long-term upside that we expect to capitalize on. Really appreciate your attention. Thanks for coming.